So we're going to do a third option. So seniors really need to understand the first two, but the third one is one that is important that you understand as well, and it's the net worth programs. Net worth programs. So Rosa-Lee's going to help us understand that. So Rosa-Lee, help us out here. What are net worth programs? Right? I've never heard of that. A senior may say. I don't know what they're talking about. So what is it, and how do these net worth programs differ from traditional mortgage options?
So, with the net worth program, it's designed for high net worth individuals and it focuses more on the investments that you currently have, the liquidity of those investments, and your overall balance sheet. So, it's
Yeah.
less reliant on your traditional employment income.
Hmm.
Traditional lending focuses on your month to month paycheck, what you pay yourself every year, or
Hmm.
what you earn every year, whereas the net worth program evaluates your overall financial strength.
Yeah.
Um, these programs are best suited amongst the early retirees, I would say, because again, with this program, what makes it similar to your traditional mortgage is that you still have your monthly mortgage payment. So
Mm.
essentially, it's your traditional mortgage. It's just the way you qualify is different. And your mortgage amount of what you could potentially tap into is almost like dollar for dollar what you have available in terms of your investments and liquid assets. You typically will see business owners use this as well. Those, especially that are exiting businesses, tend to fall into this program.
Hmm.
Clients, of course, with large investment portfolios, as
Hmm.
well as high asset, low income households, because you can have people that have a lot of assets, but
Yeah.
in terms of what they earn, in terms of salary and things like that, it can be low income.
Well, that's very good. It's very good information. When you were talking there, I was thinking about something that, if if I'm at an early retirement age or pre-retirement age, one mortgage may be best suited for me, right? But then as the years go on and my circumstances change, then one of these other three, you might want to consider shifting to one of those, right? So that's where, when you work with a competent mortgage broker like Rosa-Lee, at the different phases of your life, she can help you think through, ask questions, no pressure type of discussion, so that you can think and make reasonable decisions uh, for yourself over the long term. So focusing on this net worth programs here, you've mentioned a little bit already, but who are these programs for? Just kind of re-clarify, who are these programs best suited for among retirees or near retirees?
It's typically early retirees,
Mhm.
again, just because they tend to have more income, or those prior to retirement, or anybody with a large investment portfolio, essentially, with
Yeah,
intentionally low taxable income.
yeah,
Yeah, as you'll find people that have like that already work with financial professionals or
yeah,
accountants and things like that, they tend to have a
yeah.
strategy in place. So they tend to be able to fall into this category if they have a large investment portfolio and a
That's good.
strategy in place.
That's good. That's good. So here, last question on this particular solution, and then we're going to look at just a couple more things before we go here. But how do seniors, well, how does it help them maintain flexibility as financial needs change over time, this particular mortgage?
It allows clients to preserve their investments. So think of it in the sense of, let's say, if you were to go the traditional mortgage route when you have low
Mhm.
income, you may
Yeah.
be required to pull more from your investments to put a larger down payment, let's say on a
Hmm.
second property or things of that nature.
Hmm.
Um, or even pulling equity out your property can be really expensive and trigger a tax event. It also allows seniors or those type of clients to create access to lower cost capital. So
Yeah.
instead of taking out a traditional, like a regular bank loan, for example, you can just pull equity from your property and use that
Mm.
for, investment purposes or even lifestyle transition. So there's a lot of ways to go about it, but essentially it just allows you to avoid having to pull your investments out and have access to capital.